government has just revealed what looks like the biggest stimulation, recapitalization, economic reconstruction plan in a very long time. In fact, if you add up everything, it looks like 9 lakh crore rupees. It's a lot of money. But underlying all this, the crisis as well as a possible resolution is the state of India's banks, especially India's government-owned or public sector banks. And a lot of the money is going in that direction. If those are fixed, the rest will fall into place. And whether those can be fixed or not, and how will this plan work, who better to explain to us but the man who started it all, Arvind Subramanian, Chief Economic Advisor. You started it all by talking about this mysterious twin balance sheet problem.
That's true. Yeah, I think, see, this is something that happens all over the world, right? There's a period of boom. A lot of lending takes place, over-lending takes place. The boom fizzles out, and then you're left with a lot of bad assets with less value than the original that you thought you had. And it shows up in two places. It shows up on the balance sheet of firms because they have too much debt. So that's one balance sheet. And the equivalent is
the lender, the bank.
The bank, and it shows up on the banks. So what the twin balance sheet challenge does is it reduces spending by firms, right? And that brings down the economy.
And the employment.
And the employment and growth and investment and everything. And it, on the bank side, because they have weak balance sheets, they are unable and unwilling to lend to finance that spending, right? So this kind of coming together is a pretty serious problem, and it's been one of the major challenges for the Indian economy, for the last 4 or 5 years. It's not just this year or last year, ever since the global financial crisis happened. So if we can make progress on that, which this package is aimed at, then I think we can unclog one of the critical bottlenecks and then get the investment cycle back again, the growth cycle back again. So that's the aim of this package.
So how do you tie these two together? I mean, you have the option. Either you take them to the Sati pyre and let both burn, which is what's happening right now.
Yeah.
They are walking into a what do you call it, Johar Kund,
yeah.
Right? I mean, times of Padmavati, I can say that, and committing Sati together. That is the entrepreneur as well as the bank. Or you take them somehow to the Ganga and give them a Ganga Snan and cleanse them of their sins.
Yeah. Those are kind of good metaphors, but I think that maybe it will help to say, and this is the way I like to think about this, to do the Ganga treatment, you need to do 4 things, right? I call this the 4 R's. First and foremost, you got to come clean on the problem. We call it recognition. What is the
As long as you don't say 3 R's, you can get away with it.
Exactly.
But
Okay.
don't say RRR,
No,
R3.
Okay,
Yes.
yeah. The 4 R's, first recognition. How much, stressed assets do we really have? So in 2015, the RBI under Raghuram Rajan launched this asset quality review.
Just when we mentioned R3.
I know, exactly. By March 2017, we got a good sense idea of what they were. So that's the first part. Then
so how do those compare with what the banks currently state on their balance sheets? Are they speaking the truth? Or as you say, it is about 80–85% of the truth?
See, first thing is that I think they've done a very good job, the regulator and the banks have done a good job of coming clean. Because one manifestation of that is that, it's not that the total stock of stressed assets has gone up a huge amount. It's the amount that we called that was stressed but not non-performing, that has become non-performing. So there's more clear recognition of that. Right? So that's the first part, the recognition part of it. Then the question is, okay, but you were saying, do we know? I call this the Subramanian law of non-recognition. It's not based on me knowing more than you about these things. I think it's always safe to say that everywhere and always the amount of stressed assets is more than what anyone says it is at any point in time.
It's a universal principle.
It's a universal principle.
Yes.
So I think that, while I think now we've kind of come clean on this, prudence requires that we assume that there could be more, and we should be prepared for that. Right. But first, up to first order, I think we've come, we've now recognized. That's the first start. Then we need to do, because remember the 2 balance sheets. we need to do resolution, which means that what's on the balance sheet of the firms, that needs to be resolved. And that's politically very tricky. And then...
Yeah, because you can't be seen to be giving taxpayers money
exactly.
to a failed businessman.
Exactly. And then, you know, so there again, it's tricky for two reasons, right? You see, because the problem, underlying the problem, there were two problems. One is unethical, dishonest lending, is what is crony capitalism stuff. And the other category, which is honest mistakes being made because of over-exuberance and things.
Or the business just going bad.
Going bad, you know, the adverse circumstances change and so on. And I think that it's very difficult to make that distinction, I think, in the political domain, because, you know, because in principle you would want to treat those two differently. Right. Because in one case you say the guy has to be punished, the guy who did that, both the lender and the borrower. And the other guy, the other case you want to say, you know, honest mistakes are made. This is what risk-taking is about. I mean, show me a place where there's no risk-taking and I'll show you a
This is what limited liability is about.
Exactly, it's a limited liability about. You want some risk-taking, but you also want, you know, some consequences to, you know, excessive risk-taking. So that's the resolution side. There, I think the big advance was, you know, the new bankruptcy law, and the decision of the government and the RBI to push with it. And we know that 12 big cases are already in the NCLT process. Another 30 to 40 cases.
Since all our viewers don't know all the acronyms, and now there are too many. What is NCLT?
I think, again, even National Company Law Tribunal. You know? So it's basically the bankruptcy proceeding.
Right.
So there are 12, and then another 30 to 40 could potentially go in. And that is a forum, basically, where the creditors and everyone gets together under the supervision of an independent professional. And they say, look, what are these things truly worth? Let's value them. Let's get bidders to come and buy them. And that process works out, right?
So the promoter loses his assets and equity. So it's not as if they take the money and go home and start again.
No, not at all. So you know, so there are consequences there. You know, promoters take a hit, banks take a hit. Conceptually, that is a process for allocating the losses. That's what it is. Yeah. How much the promoter should.
Because what happened in the past was that promoter did not take a haircut. Yeah. He got a hair transplant, and the bank took a mundan.
Exactly.
Not a haircut.
And also remember that the notion of a promoter who put in his own equity also was a little bit tricky, because...
Yes, because they gold-plated.
Exactly. They borrowed, basically. Right. I mean, I think one way to think about this, actually, what you just said, is that I think during that era, we never had limited liability capitalism. Right. There was no equity at all in this. Right. So that's part of the problem, right? So that resolution process is happening on one side. But we have to work simultaneously because remember, the banks are not able to lend because they don't have enough money, basically, you know, regulatory, you know, the regulators say you have to have a certain amount of money.
As capital.
In order to support your lending. Right. And given the underlying value of the assets, you know, maybe there's not enough. So what the government has now done is to put in money into the banks. So the announcement, there are three parts to this. One is the government is just going to give budgetary support. That is regular thing, what it was doing under Indra Dhanush, the previous scheme, put in money. Second, the big, you know, now given that we're into these Hindu metaphors, the Brahmastra that's been wielded is the 1.35 lakh crore in recapitalization bonds. Basically, the government will issue these bonds, banks will hold them.
The English translation of Brahmastra is weapon of mass destruction.
Yeah, weapon of...
it's a tricky metaphor to use.
No, I think more and more it's
a guided missile. Okay.
The bazooka is
the bazooka. But a guided one.
The guided one. And so the banks will have this asset. Government will have a higher stake in these banks. Then they'll have enough capital to make good whatever losses they will have, and then they can start lending again.
So the government equity in banks goes up instead of going down as it.
Initially it goes up, but here I think, Shekhar, one has to be a little bit careful here, because I think there's a tendency to say, oh, this is more government ownership, but I think that's being quite unfair for two reasons. One, you know, you have to do this, right? You own the banks, you have to do this. Second,
because if one collapses, there will be a domino effect. Yes.
But the second thing is that, and this has actually happened, which is an interesting thing that, you know, few people have recognized, the government putting this money has increased the value.
Yes,
so that the government...
In fact, I noted it that day. Notionally, government got 80,000 crores back.
Exactly, absolutely.
Yes, market caps went up.
Yeah, that's a very good point. Exactly, market cap went up. And so now that's what. And so what this allows the government to do is actually reduce its stake.
In fact, that's a similar thing happened with UTI.
Exactly.
Suti.
Yeah, exactly.
When UTI had a crisis,
Exactly.
they put those shares, government shares in Suti as it's called.
Yeah.
And now that's worth a lot.
Lot of money. Exactly. Yeah. And then the government sells it and gets back the money.
Yeah.
So in principle, so that's happened. So now this is going to allow the banks, so it's going to kind of unclog the financial system and allow the credit process to revive itself. Now, 2-3 things to remember here. One of the, I think, slightly unnoticed benefits of this is the following. Resolution and recapitalization are linked in the following sense. See,
so your R's are recognition,
resolution,
recap.
I'll come to the fourth in just a second.
But recapitalization, the fourth you will come.
Yeah. And remember that the connection is that resolution has been held up to some extent because banks don't want to write off the true because then they say, where's the hole? Who will fill the hole?
But they worry about the CBI.
See, that's the whole other dimension. But even financially, if you say that your loan is actually worth, say, 30% or 40% of the thing, who's going to fill it up? Now, given the comfort that government has provided by saying the hole will be filled, that actually will facilitate the resolution process as well. So I think that's the second and third R. And the fourth R is reform, right? Which is the following, which is that, remember, we're doing all this, but we don't want this pattern to recur in the future, right? Because after all, I mean, you have created perverse incentives, right? You are using taxpayer money, as you said, to bail out, some guys. And so you've created perverse incentives.
I mean, in my view, we keep on compounding the initial crime that Mrs. Gandhi committed by nationalizing these banks.
Yeah.
Because these monsters have become government liability, every 10 years, they are like Bharat ki ghodi in India. Have you seen a Bharat ki ghodi? Yeah. Every 100 yards it stops, then people have to go and do a jig in front of it. Right. Our public sector banks are like that. There is an inevitable crisis every 10 years and government pours more money.
Yeah, so I think we need to break that cycle, right? That's what I think the reform process has to be. Now, I think that looking ahead, decisions we take, including in terms of how we recapitalize, should be animated by a sense of where we want the banking system to be 5-10 years down the line.